Good morning. Today is a new month, September the 2nd. Hi, Andy. How's the world treating you and what do you think?
That was an interesting week last week.
Yeah.
Looking forward to this long weekend to digest what happened. Markets moved quite a bit, particularly the fixed income market, on what was largely moderate data across the board. Um, Certain parts of the fixed income market, in particular the front end of the yield curve, rallied, while the long end rallied and then fell right back.
Yeah. Now, that's certainly a theme that the bond market has at the moment. The yield curve wants to naturally steepen. It's had enough of this flattening and being as inverse as it's ever been in the history of the bond market. So that's probably something that's going to continue, especially given the QRA and given all the issues that we're going to get over the next few months, both in the treasuries and in the corporate sector. And I think that will continue to happen. What did we really see last week, though? We saw a little bit of moderation in the employment data, which should make the Fed quite happy, right, Andy?
Yeah, I mean, the specific data that we saw was the JOLTS data, which is the job openings that corporations have that fell. So that means that either they have less demand for workers or they've successfully found workers. But in this case, it means there's less demand for workers. And that surprised pretty radically. And that we know is a number that the Fed cares about. The rest of the data, the NFP was in line, slightly above, while the unemployment rate was higher by to 3.8%, which is really a political that number is very flaky, and but the politics matter on that number. So, and the inflation related data we saw showed some bottoming at some level, but nothing to write home about that all of a sudden we're going to have a reacceleration of inflation, but also not anything that looks like inflation is dead.
Yeah, I mean, a lot of the theme this week shifted towards the possibility of the immaculate disinflation and also the soft landing. And that is probably why people bought equities. As you say, TLT over the course of the week was completely unchanged. The short end, a few basis points lower, but nothing to write home about, certainly not a trend. But equities, up nearly 2%, just short of. So obviously people prefer equities to bonds. We are in the bonds a good 5% lower than we were when the QRA came out. So we got that one absolutely spot on. And in the equities, we're only 1.5% lower. So people just keep on buying equities, preferring them to bonds. Do you think this trend will continue? What do you think?
Well, I mean, I think the whole point of the supply issue, which is the US Treasury issuing far more bonds than expected and putting the teeth back into quantitative tightening, is going to be led by the long end bond yield selling off. But it is remarkable that with TLT down 5% in a month and yields at one point making new cycle highs, going past their October highs. It is surprising that equities have held up. I think that's by and large because the economy itself is continues to surprise on the upside to most participants, and the strength of the Magnificent Seven or so stocks that get bought on every dip.
Yeah, it's very noticeable that really, if you look at every other index or every other subsector or sector, they are really unchanged year to date. The Dow is up less than inflation. Even the sectors that should be on fire, like ITA, the defense sector, is up with inflation. So really all the performance is in these magnificent seven. and nowhere else. How long that can continue, I have absolutely no clue. What do you think?
Yeah, I mean, valuations are clearly stretched across all of those things. And, you know, the reaction to the Nvidia earnings, I thought was going to turn this a bit more. We're basically where we were on Nvidia prior to the earnings announcement. And, you look at the rest of the earnings, in particular, say for example, Apple's gross earnings, I mean, not its earnings per share, its gross earnings have fallen. And so you look at earnings generally, and the Magnificent Seven does comprise a significant amount of the S&P 500 earnings. We're going to come in, if we match expectations for the second half of the year, we're going to come in with a year over year earnings growth of less than 2% in an economic environment in which we may have 7, 8, 9% nominal GDP growth, which is terrible earnings relative to the GDP. Pretty much all of us expect the GDP in 2024 to be nominal GDP, which is a combination of GDP and inflation, to be much lower. And yet earnings expectations from analysts are up 12% in 2024 and another 11% in 2025. And so, those expectations seem extremely rosy to me. You take that and the very high PE of some of the market in general, we're still 19ish PE. It's very hard to see a lot of upside in equities without something that would be very, very bad for bonds, which is, an acceleration of inflation.
Yeah, and if that were to happen, still stocks would fall because multiples would compress them. They would fall less than bonds, but they would still fall. And I completely agree with you. I think in a long term book like the one we are running, to start chasing equities just because they're not falling, I think it's suicidal and it's silly. And we have to remain consistent with our philosophy.
Yep. And, the last couple of weeks, certainly last week, was an extremely illiquid period of time with a tremendous amount of data and auctions all stuck in. Let's see how September plays out before we, make any great conclusions over what happened last week. So, what about next week?
Right. Well, very light calendar next week. And of course, Monday, we're all on holiday. All we have really is PMIs, which let's see what they are, but I don't think they're going to move the needle very much. And the week after that will be more interesting because we get a lot of bond supply, both treasuries and corporates. And let's see how the market absorbs those. But as I keep on saying, I think there's very little alternative to the yield curve steepening over time, and because we're just very, very close to terminal rates by the Fed. Unless CPI is very much out of line in 2 weeks' time, I think it's very easy to conclude that the Fed is going to be happy and do nothing in September. And then we have another slew of data before the November meeting, and we just basically, replay everything that we've played over the past month and a half. Non-farm payroll, is that going down as a lot of people expect, and is inflation moderating or not? But
Right.
as you know, the we are discounting a lot in terms of easing already. So probably I would have thought not a lot of change in the bond market apart from a steepening yield curve. And that really to me says that equities have very, very little upside.
Yeah. So just following up on specifics for next week, because it's so light, it may expose sort of the flows more so than the changes on economic data. And, I think we're both concerned about the long end for risky assets because of the overlay that we mentioned in the QRA. And so that should keep pressure on longer assets. But it is interesting, and maybe we can glean some information. It seems that 2-year notes and 5-year notes are probably the place where there's the most offsides positioning, and in particular as it relates to 30 years and 10 years, in that there's been quite a lot of interest in positioning for flattening yield curves and falling and rising interest rates in the short end. And I guess it's possible we could see some steepening. We think steepening, regardless of the environment, whether it's a lower economic output or a supply driven or a higher one where the supply really kills the long end. We see steepening, and I guess both of us are concerned about the potential for sort of an aggressive steepening at some point, at any point in time in the near future. And, again, it usually requires data, but maybe we see something in flow this coming week. Otherwise, it's likely to be a quiet week.
Yes, absolutely. And as a result, I see absolutely no reason to change our macro outlook. Still higher for longer, but with a steepening tendency in the yield curve, which should limit volatility to the upside in equities.
Yeah, I'd like to edit that a little bit with higher, probably not anymore for the near term.
Yeah,
Like, we're really close to the Fed being done. So
maybe we should
higher
say
short,
high for longer.
right now, maybe high for longer or pause for longer, because I think it's possible that we're now in a position where economic data could go either way. The inflationary reacceleration pressure could occur. A rolling over of the economy could occur. We don't know, but it seems quite clear they're close to done for this particular hiking cycle, and they're going to pause for longer. And then the question is, will they have killed inflation or not? And we won't know that for many months. So when we do know that, we'll know if it's going to be higher for longer too, or cuts.
Yeah. And really, it's going to be interesting to see if all these hikes somehow kill the economy at some stage. Uh, I don't know. I mean, I'm very uncertain about that one. The resilience of the U.S. economy is far greater than the resilience of other economies. So it seems to me that the likelihood of the U.S. economy rolling over is far lower than the likelihood of Europe rolling over,
Six
and that's
trillion
why
dollars will do that.
yeah, and that's why I keep on looking at the European equities as a leader towards what is going to happen in US equities, but less so. And I did have noticed that on Friday, European equities were particularly weak. So we will see what happens there, but we will keep you updated in any case.
Yep. So nothing with the portfolio, I expect.
I'm going to do that in the next part, but no, nothing with portfolio. It's time to sit patiently and watch.
Great. Thanks, Nick. See you next week.
See you next week. Have a good one. As we just said in the episode, we've done nothing because there were no orders naturally, and this is what our allocations look like. We've still got a very high proportion in cash, and we are sitting here patiently looking at what to do next. I think patience is going to pay off. We will probably be adding to our position in VWOB as yields come down towards our targets. We still have about 3-4% to go there before we do anything, and we'll be ready to start buying equities when we know whether the economy is rolling over or not. Either way, we will be ramping up our allocations in both bonds and equities at different price points over the course of the next 2 or 3 months. Otherwise, the monthly performance is updated in this tab. We have everything updated in terms of monthly and daily. It's all down here. All you have to do is click on these links and the portfolio will appear for you. Thank you very much.